Hello, I'm Diane Holt, Transactions Team Lead with Bloomberg Law. I'll be speaking with Chris Letang of SRS Acquiom about evolving deal terms in the private target space. First, I want to introduce Chris. Chris is the Managing Editor, Escrow and Payment Solutions at SRS Acquiom. He works with clients and shareholders through closing and the post-closing escrow and payments process. Previously, Chris led the teams that handled post-closing escrow claims, earnouts, purchase price adjustments, distributions of shareholder proceeds, and other activities relating to serving as a shareholder representative. Before SRS Acquiom, Chris practiced corporate law with Cravath, Swain & Moore LLP and at Cooley LLP. So we've asked Chris to join us today in particular because of his unique exposure to private deals, especially private target deals. He sees the deal documents for a broad range of private transactions involving private equity, venture capital, and closely held and family operations. Combined with his experience as a transactional lawyer, Chris has unique insights into drafting trends. During my interview with Chris, we'll touch on some recent trends in M&A and closing, the divergence between insured and uninsured deals, and a survey he's conducted on ESG, or environmental, social, and governance issues. So on our first section here, Chris, we're going to be talking about material adverse effect and closing conditions. So while the beginning of the pandemic, which was declared on March 11, 2020, led to an instant pause in deals, by June it was pretty clear that the M&A universe was back in business, and it really has been ever since. In fact, it's been breaking records since that part of the pandemic last year, especially in the United States and especially in certain sectors such as technology. Though we initially thought the pandemic might suppress the market, the opposite has been true. So can you tell us, based on what you're seeing, Chris, a little bit about what you see moving forward?
Sure, absolutely. I mean, I think you stated it correctly, Diane. I mean, when we were sitting here in March and April of 2020, we were all sort of wondering, what was going to happen to the M&A market? Were deals still going to get done? But then relatively soon after that, the market just started roaring forward after that. And so really, I just want to touch on a handful of trends here and that we've identified over the past year, just some big picture things, some really specific to representation and warranty insurance and the like. We've really spent much of the last year plus, watching and trying to determine what deal terms are changing as a result of the pandemic, and why, and also observing how the things are changing as the market has come back to life. So just a couple brief trends to highlight here. First one is noted on is on this slide, which this shows the percentage of deals that had the pandemic as a carve out to the material adverse effect definition. So in other words, if there was a change in financial condition or the like due to the pandemic, it would generally not constitute a material adverse effect. And I show this slide because this was the biggest change we've ever seen in a deal term since we've been doing these studies. This went from a term that we didn't even track at the beginning of the year to it being a provision that is included in some form in 3/4 of the deals by Q3 of 2020. Although interestingly, the percentage of deals with that provision had already started declining somewhat by Q4. So it will be interesting to see what the data says for this year around how this played out and how the parties are allocating risk on this point as the market has really corrected and gone to new heights. Another feature of the last year has been both a skyrocketing stock market and, at least for a while, uncertainty about what the pandemic would do to company valuations. And those two items play themselves out in the data that we show on this slide. We've seen a pretty steady increase in the percentage of deals where buyer equity is a component of the consideration. By 2020, we're up to 21% of deals that had an equity component. And this was especially pronounced on larger deals. And so I think this was a function of parties using equity to bridge valuation gaps between what sellers wanted and what buyers were willing to pay during the time of disruption in valuations. But then also, because of the way equities have performed since the start of the pandemic, I think this has really been a good way to add that upside to the sellers and bridge those gaps. So, just at a real high level, those are just a couple of the items that we identified from 2020 that we're watching as things move forward in 2021.
Yeah, thanks a lot, Chris. And I think it will be interesting to see with the MAE, we're beginning to see some movement of pandemic-related terms into other parts of the agreement. My colleague Grace Morel Burnett has written about that, and in terms of cash versus non-cash consideration, I think it'll be interesting to see if that trend that you spotted is continuing. So shifting over to reps and warranties insurance and some of the trends you're seeing now, this is especially important for private equity deals. Because reps and warranty insurance is becoming nearly universally required. So one of the things you and I have talked about, and I'd love for you to at high level to make a point about before you go through your slides, is a little bit what you're seeing in the divergence in market terms between insured and uninsured deals.
Yeah, absolutely. Diane, as you point out, just another trend that has been unmistakable over the past several years really has been the rise and use of rep and warranty insurance. So, in these slides, we'll sort of touch on, a handful of deal points where, the deal terms just look dramatically different in deals that have rep and warranty insurance, and how that's really pushing itself out, across, some major deal terms such as, what's the survival period and what are the escrows that are set up, but also into some, just some more mundane provisions as well. So it's, RWI, just as it's expanding out and we're seeing it in more and more deals, it's really having a big influence in a lot of ways on how the terms of the deals are being negotiated. The first area I just want to focus on is escrow sizes and survival periods. And when you're looking at deal terms that change when RWI is involved, the primary one is the size of the escrow fund. Escrows in deals with RWI are typically around 0.5% of deal value, as opposed to somewhere around 10% of deal value in deals without RWI. But one thing that we thought was notable was how seller indemnification has shifted to becoming even more limited in deals with RWI, particularly over the last year. And you can see from this slide that there was a pretty big increase in deals that had no general survival period in 2020, or no general escrow fund. So, these no survival and no indemnity terms deals were really being particularly, the no survival and no indemnity terms were really being driven by deals with RWI, where around 40% of deals had those features in 2020. So, definitely an interesting shift there. And you can really see, again, the divergence between deals that had RWI and those that didn't when you're looking at those survival and indemnity terms. Corresponding with the fact that there's more deals without a general indemnity escrow fund, there's a clear correlation that we see in deals with RWI where parties are setting up a separate escrow fund specifically to cover the purchase price adjustment. And this is probably the deal term that is the single most highly correlated with RWI. Around 80% of deals with RWI had that separate PPA escrow, while only a third of deals without RWI had that structure. And you can see that trend from the aggregate numbers here as well. If we move on to the next slide here, just another thing to note here is we've also been seeing a trend that the size of these escrow funds has been increasing too, perhaps so that the buyer is assured of having the funds there to cover any claims, particularly if their recovery is capped out at the escrow amount that's set aside for the purchase price adjustment. So, the overall trend that we're seeing here is, really just less items subject to indemnity on the sell side as RWI has become more and more influential. And the last point I'll make here is that there are numerous other seemingly more mundane provisions that are out there where RWI is having an influence. For example, you can see from this chart that in deals with RWI, the buyer is more likely to agree to what are called no other representations or non-reliance clauses. And although it's true that there's often a fraud carve-out associated with these provisions, broadly speaking, the purpose of these provisions is to limit seller liability to statements made in the merger agreement, and by extension, to limit the seller liability. And by extension to limit liability to the things that the RWI policy is more likely to cover. So, that's just one example of how the structure of these policies is really influencing specific deal terms. And we're also finding numerous other things like that in our data, and things like how other reps and warranties are structured, baskets, sandbagging, and other indemnity provisions and the like. So again, RWI, just as it becomes more predominant, is really influencing those deal terms heavily.
Yeah, thanks, Chris. I think that's really interesting. And I think one of the things that I will wonder about is whether the discipline from the insured market is going to trickle over into the other side, or whether there's actually going to be a little bit of sort of not quite forum shopping, but sort of deal environment shopping for certain kinds of deals potentially. Let's move on now to the ESG portion of our conversation. And I just wanted to briefly mention that the environmental, social, and governance issues that we're looking at now have a little bit of a beginning in history. Back in the 90s, the corporate social responsibility movement, which was really a marketing effort, really stayed in the marketing department of firms that were making those efforts, including in the financial industry. But then what happened about 15 or 16 years ago is that the UN Secretary General took an initiative and brought together about 20 financial institutions around the table to try to talk about thinking more holistically about investment funds especially. And that movement has really taken off. And what we're seeing in your data now is the movement, the sort of the shift from that movement within the sort of investment fund and financial industry area over into the corporates. And we saw that in 2019 with the Business Roundtable making a statement about the importance of looking at different stakeholders. So can you tell us a little bit, Chris, about the SRS Acquiom survey, the barometer that you looked at about ESG? And let's take just a couple minutes to highlight the key points here from your survey.
Yep, absolutely. Yeah, so that really is the question, is in the discussion in recent years, is how ESG factors really are influencing investment strategy, and how much weight to put on them. So we did put together a survey around these factors. This included law firms, strategic buyers, investment banks, private equity firms. So really a broad cross section of the investing world, and we found some intriguing results. The first point is that well, around 40% of respondents said that ESG factors were either somewhat or very important. Nearly an equal percentage said those factors were either very or somewhat unimportant. So a real split in terms of how the market is thinking about those factors. When we asked what areas of ESG will have the most impact on the M&A strategy, a little quarter said that there would be no influence, but around 70% responded affirmatively. Of the 70% that responded affirmatively, environmental and governance factors appeared to be the most predominant. The most important factor that we identified was really related to brand and reputation. Essentially, parties believe that taking these factors into account in their investing strategy could be good for their brand. And so other relevant factors included there were external pressure from regulators and the like, and future financial results, but brand and reputation were really important. So yeah, one area where ESG factors definitely did appear to play a role was in deal dynamics. Around half of participants noted that they saw additional steps in the due diligence process around ESG factors, and nearly the same percentage saw changes in reps and warranties. But in the same respects, when asked how actively they're evaluating ESG factors in due diligence, around half said that they review those factors only occasionally when the topic is relevant, and only 13% said they review it in most deals. So, and finally, the survey indicates that that notwithstanding what we've talked about here, less than 20% said that they'd be willing to sacrifice deal economics to support ESG. And over 40% that they wouldn't, that only 40% said they would not do that at all. So, what we really end up with is really kind of a mixed bag. ESG factors are, important to our segment of the market, and we are seeing some real world impacts on that. But there's still a big segment out there that aren't as much concerned about ESG factors, and very few are willing to sacrifice economics over them.
Thanks so much, Chris. I really appreciate your contributions today.